You are 31 years old. You have $50,000 invested. Not easily. Over 4 years of automated contributions, missed splurges, and staying in an apartment one upgrade smaller than you could technically afford. $50,000 sitting in a brokerage account, compounding quietly while life continued on the surface. Then the market drops 9% in a single week. You open the app, not because you plan to, because something pulls you there. And for the first time, the number staring back at you is not abstract. It is not a percentage on a graph. It is $4,500, gone, in 7 days, without your permission, without a single decision on your part. You have two versions of yourself in that moment. The one who understood intellectually that markets fluctuate, and the one who is feeling $4,500 disappear in real time, and discovering those two people are not the same person at all. Nobody warned you that $50,000 was a number where investing stops being a concept and starts being a psychological test. Level 1, you have almost nothing invested, and risk feels completely theoretical. If content like this interests you, please hit the like and subscribe button so you don't miss our next video. A 10% market drop on a $2,000 portfolio is $200. You read about it in a headline, maybe check the app once and move on. The emotional stakes are low enough that discipline is easy. Staying the course requires almost no psychological effort because there's almost nothing at stake emotionally. This is why level 1 investors consistently overestimate their risk tolerance. They have never actually felt real money disappear in real time. They have only modeled the scenario intellectually, and intellectual models of loss are always more comfortable than the actual experience of it. Level 2 is where contributions become consistent. The portfolio starts growing with intention. $5,000, $10,000, $15,000. The numbers feel meaningful, but the volatility still registers as manageable. The difference between level 1 and level 2 is not portfolio size. It is the moment you first check the app during a down week and feel something you did not expect to feel. That feeling is the earliest signal. And most people have no framework for what it becomes at $50,000. Level 3. The portfolio crosses $25,000. Something shifts here that most investors notice, but cannot fully name. The contributions still matter. They are still moving the needle meaningfully. But for the first time, market movement starts competing with your contributions as the primary driver of portfolio growth. A good month in the market adds more than your monthly contribution. A bad week erases 2 months of disciplined saving in 4 trading days. The math is no longer purely in your control, and your nervous system starts registering that loss of control in ways it never did at $5,000. Level 4 investors, $35,000 to $50,000, experience this acutely. Volatility that was previously background noise becomes foreground data. Every Federal Reserve announcement, every inflation report, every earnings miss from a major index holding now has a direct, calculable impact on a number large enough to feel personal. This is where investor identity begins fracturing. The person who said they were comfortable with risk at level 1, when risk was theoretical, meets the person they actually are at level 4, when risk has a dollar amount attached to it that genuinely matters. Most people are surprised by who they meet. Level 5, $50,000. This is the exact threshold where the psychological rewiring becomes unavoidable and where most investors make their first significant behavioral mistake without realizing it is happening. At $50,000, your portfolio is generating approximately $5,000 annually in average market returns. That is real money. Money that took you months of contributions to accumulate manually, now appearing or disappearing based entirely on market conditions you cannot influence or predict. And here is the specific cognitive trap that activates at this level. The portfolio is now large enough to feel like something worth protecting, worth managing more actively, worth watching more closely, worth adjusting when conditions feel uncertain. Every one of those instincts is understandable. Every one of them is financially dangerous because of behaviors that feel like protection at $50,000, checking daily, rebalancing reactively, moving to cash during volatility, are statistically the behaviors most correlated with underperformance over the following decade. The portfolio graduated. The emotional response did not. And the gap between those two things is where long-term wealth gets quietly damaged by investors who are trying genuinely to do the right thing. By level 6, the investor who navigated the $50,000 psychological threshold without capitulating to reactive behavior has crossed something permanent, not a number, a proof point. They held through the correction that felt catastrophic and watched the portfolio recover. They experienced a specific discomfort of seeing $5,000 disappear in a week and did not sell. That experience, survive intact, produces a psychological upgrade no course or book can replicate. Volatility tolerance built through actual exposure to volatility, not theoretical modeling of it. The behaviors at level 6 and 7 reflect that upgrade directly. Market drops trigger contribution, increases instead of panic. Portfolio rebalancing happens on a schedule instead of an emotional reaction. The daily app check gradually becomes a quarterly review, not from neglect, but from earned confidence in the system. Level 7 is where the compounding math becomes almost uncomfortable to look at directly. Annual returns now exceed annual contributions. The portfolio is adding more wealth passively than the investor can manually deposit. Every year that passes without behavioral interference accelerates this gap further. The investor is no longer pushing the machine. The machine is pulling them forward. At the highest levels, the psychological relationship with risk transforms entirely, not because the volatility disappears, because the investor's identity finally catches up to portfolio's reality. The nervousness that arrived at $50,000, the visceral, app-checking, sleep-disrupting anxiety of watching real money move in real time, gets replaced by something quieter, something closer to perspective. A 10% correction at $500,000 is a $50,000 paper loss, larger in absolute terms than anything experienced at level 5. But the investor who reached this level by surviving every correction between $50,000 and $500,000 without behavioral interference has built something the number alone cannot measure. Emotional durability, the lived, compounding, experiential understanding that corrections are temporary, that time resolves volatility, that the portfolio's job is not to feel comfortable, it is to compound. The rules that govern early levels no longer apply here. Saving rate matters less than asset allocation. Contribution size matters less than sequence of returns management. Tax efficiency, estate positioning, and withdrawal strategy enter conversations that were relevant at level 3. But none of those advanced conversations are accessible to the investor who sold during the correction at $50,000 and never rebuilt the position. Everything at the top levels was earned by surviving the middle ones. So where are you actually, right now, in the psychological journey? Not where your portfolio balance says you are, where your behavior says you are, because behavior is the honest answer. Level 2 behavior looks like this. You check the portfolio occasionally, contributions are inconsistent, and a market correction produces mild discomfort you recover from quickly. The stakes still feel manageable. Level 4 behavior looks like this. You check the app more than you planned this week. A down day produces a specific, locatable anxiety. You have thought about moving a portion to cash at least once in the last 6 months, and talked yourself out of it, or didn't. Level 5 behavior looks like this. The $50,000 threshold arrived, and the emotional experience of volatility genuinely surprised you. The investor you thought you were and the investor you are behaving like are measurably different people. Level 7 behavior looks like this. Corrections are calendar events, not emergencies. You stopped checking daily sometime in the last 2 years and cannot remember exactly when. Here is the honest question. Which description made your stomach tighten slightly? That tightening is not weakness. That is your current level identifying itself and asking you to move. If you want to move from wherever you are to the next level, there is one thing that matters more than portfolio size, asset allocation, or investment strategy right now. Building a behavioral protocol before the next correction arrives. Not after, before. Because corrections do not announce themselves with enough warning to build a framework in the moment. They arrive fast, feel permanent, and activate exactly the emotional response that produces the worst possible financial decisions. Here's the protocol. 3 rules, written down before the market moves. Rule 1, No portfolio changes during correction exceeding 10% until 72 hours after the urge to act arrives. Urgency in investing is almost always a psychological signal, not a strategic one. Rule 2. Every market drop above 8% triggers an automatic contribution increase, not a freeze. Automate this response in advance. So, discipline does not require willpower in the moment. Rule 3. Remove the daily app check entirely. Set one calendar reminder per month. The portfolio does not need your attention daily. It needs your restraint consistently. The investors who build real wealth are not the ones with the best strategies. They are the ones who protected their strategy from themselves at $50,000 when the psychological test arrived and nobody warned them it was coming. Now you've been warned. If this gave you a framework you needed, subscribe, because every week we go deeper into the financial decisions that actually change the trajectory